Number one, U.S. interest rates and yields. The first and probably most important factor is the correlation between gold and interest rates. Gold doesn't pay interest. That means when yields are rising and high, the opportunity cost of holding gold is also high. But right now, markets are betting heavily on interest rate cuts from the Federal Reserve. Why? Because hiring is slowing, inflation is still sticky, and the Fed has signaled it's ready to ease. Lower interest rates make gold far more attractive relative to bonds and stocks. And this is the first time the Fed is expected to cut interest rates this year. Investors are positioning for a September rate meeting, which means at least one cut is expected, and many are betting on further easing in 2025. This anticipation of cheaper money is pouring fuel on gold's rally. Number two, the US dollar connection with gold. The second driver of the gold price rally is the US dollar. Gold is priced in dollars, so when the greenback weakens, gold naturally becomes cheaper for foreign buyers. And that's exactly what we've seen. The dollar has been softening against major currencies as traders bet the Federal Reserve is closer to cutting. A softer dollar means central banks, funds, and retail investors from Asia to Europe can buy more gold at a discount in their own currency. That global accessibility is giving gold a serious tailwind. Number three, safe haven demand. The third reason is gold's safe haven status. Let's face it, the world isn't exactly calm right now. We've got Putin cozying up with Xi and Kim, raising the stakes for geopolitical alliances. Trade turmoil is back in the headlines with tariffs threatening to disrupt supply chains again. And of course, U.S. elections are around the corner, injecting uncertainty into fiscal and trade policy. Whenever tensions rise, investors turn to gold as a hedge. It's been that way for centuries, and 2025 is proving to be no different. There's been a lot of surprises. This latest streak is fueled not just by monetary policy expectations, but also by plain old fear and caution. Number four, inflation and U.S. debt concerns. The fourth factor is inflation and debt. Despite the Fed's tightening cycle, inflation hasn't disappeared. Energy prices remain elevated, and tariffs risk stoking another round of cost increases. At the same time, the U.S. government debt is ballooning. Investors are asking how sustainable is the fiscal path? What happens if the U.S. dollar faces credibility questions in the long term? Gold as a tangible asset is one of the few instruments that investors believe can protect wealth from currency debasement and fiscal instability. These concerns are quietly but powerfully underpinning gold's strength. Number five, central bank buying and diversification. And finally, central banks. Over the past several years, central banks worldwide, especially in emerging markets, have been steadily diversifying away from the US dollar. China, Russia, India, Turkey, the Eurozone, you name it, they've been all increasing gold reserves. 2024 saw record levels of official sector buying, and 2025 that trend is continuing.